Moving on to the economy, the World Trade Organization said today the U.S. tariff rate now averages more than 20%, the highest rate in more than a century.
Short term, we have to brace for the impact. Paying off, not paid off.
In 2025, America's auto heartland was shaken like never before. 8 of Asia's biggest automakers, from Toyota to Nissan, are pulling out of the U.S. market, shutting down plants and taking tens of billions of investments with them. Over 42,000 factory jobs have already vanished. Dealerships are empty and prices are exploding. And while Detroit collapses, Canada is rising fast, threatening to replace America as North America's new auto powerhouse. 2025 will be remembered as the year America's auto industry broke under its own policies. What was once the proud heart of U.S. manufacturing is now collapsing as tariffs up to 27.5% on vehicles and 35% on key parts rip through supply chains. More than 42,000 factory jobs have already disappeared across Michigan, Ohio, Kentucky, and Illinois, forcing plants to shut down and entire communities to suffer. Assembly lines that once ran 24/7 now sit silent. Restaurants near factories are closing, and schools dependent on auto tax revenue face budget crises. New car prices have exploded by more than 20%, pushing the average cost above $49,000 and locking millions of families out of the new vehicle market. Financing has become harder as interest rates climb, and monthly payments for basic cars now rival mortgage bills. The used car market offers no relief. Fleets are holding on to vehicles longer. Trade-ins have crashed, and 8-year-old cars are now selling for premium prices. Dealers struggle with empty lots, while buyers face long waiting lists and stripped-down models with fewer features. This isn't a short-term dip. It's a structural breakdown of the U.S. auto model. Analysts warn that if tariffs continue beyond 2026, the industry's recovery could take a decade or more. Washington promised that tariffs would bring jobs back home. Instead, they've driven them away, leaving behind shuttered factories, broken promises, and a growing sense that America's auto dominance might be over for good. No companies show the cost of America's tariff war more clearly than Toyota and Honda. These two giants built their reputations and billions in profit on the strength of the U.S. market. But in 2025, that model is cracking. Toyota has already warned that tariffs could erase nearly $10 billion from its bottom line, forcing it to slash its operating profit forecast and rethink its long-term plans. Honda faces the same painful reality. It is shifting production of key models like the CR-V and the Civic Hybrid to U.S. plants to avoid some tariffs. But critical components still rely on imports that trigger heavy duties. Both companies are now investing billions in new battery and EV infrastructure, yet most of that capital is heading to Canada, where policy is stable and trade with the U.S. remains tariff-free. Toyota has leaned on its build where we sell strategy, with more than half its U.S. sales now coming from domestic plants. But even that hasn't protected it from rising costs. Honda has taken a similar path, expanding its Canadian facilities while trimming incentives and options to control expenses. The once reliable U.S. market has become a risky bet, and Japanese automakers are learning that loyalty no longer guarantees stability. Their retreat marks a historic shift, and it's one that Washington's trade policy made inevitable. For Japan's second-tier automakers, the tariff storm has turned into a survival crisis. Nissan, once one of America's fastest-growing brands, was forced to suspend its earnings guidance after warning of billions in extra costs tied to tariffs and supply chain disruptions. Its U.S. factories in Tennessee and Mississippi offer some protection, but heavy dependence on imported parts and vehicles from Mexico continues to eat into profits. Subaru, a brand deeply reliant on the U.S. market, has been hit even harder. With limited global production scale, it had little choice but to raise prices across most of its lineup, putting pressure on sales and eroding its once loyal customer base. Mazda saw a sharp collapse in exports from Mexico to the U.S., with volumes plunging by nearly half, forcing the company to rely more on its Alabama joint plant with Toyota to stay competitive. Incentives are shrinking and sticker prices rising as Mazda tries to keep fragile margins intact. Mitsubishi faces the steepest challenge of all. Without significant U.S. manufacturing capacity, it risks losing its price advantage entirely if it raises costs, but losing money if it doesn't. Mitsubishi recently hiked U.S. vehicle prices by about 2.1%, citing cost pressures from tariffs. Analysts say alliances, platform sharing, or even full withdrawals from some segments may be the only way for these brands to survive. Together, these struggles show that tariffs are not just changing profit sheets, they are rewriting the map of who can afford to compete in the U.S. auto market. While many Japanese automakers are scaling back, Hyundai and Kia are taking the opposite approach, launching one of the boldest expansion plans in U.S. auto history. The two Korean giants are pouring billions into a massive production hub in Georgia, aiming to build 500,000 vehicles per year by 2028, and have over 80% of their U.S. shares produced domestically by 2030. Their strategy is clear: beat tariffs by eliminating dependence on imports. By sourcing steel, batteries, and components inside the United States, they hope to shield themselves from trade shocks and win customer loyalty with stable prices. But this aggressive push comes with big risks. Profit margins are shrinking as construction costs soar, and the companies recently faced setbacks when Korean engineers working on the new battery lines were detained during a U.S. immigration raid, delaying production schedules. Hyundai and Kia are now lobbying both Washington and Seoul for smoother visa and labor policies to keep projects on track. Despite the challenges, their pipeline is expanding. New hybrids, extended-range EVs, and even a North American pickup truck are planned before 2030. Analysts say this deep localization could give Hyundai and Kia a powerful advantage if tariffs remain in place. But if trade tensions ease, the billions spent on U.S. capacity could become a costly gamble. Either way, the Korean counterattack is rewriting the competitive landscape and proving that in the tariff era, survival favors those who adapt fastest. While automakers scramble to survive tariffs, ordinary Americans are paying the highest price of all. The cost of new cars has soared more than 20%, with the average vehicle price now above $49,000, pushing millions of middle-class families out of the new car market. Financing is harder to get, and monthly payments for basic sedans now exceed $700, rivaling mortgage bills in many states. Tariffs on imported vehicles, foreign-made parts, and raw materials like steel and aluminum have pushed manufacturing costs to record highs, forcing automakers to raise sticker prices or strip away features to stay profitable. Buyers who once purchased new are now flooding the used market, but even that has turned into a nightmare. Fleets are holding on to vehicles longer, trade-ins are drying up, and supply of late-model cars has collapsed. As a result, 8 to 10-year-old vehicles are selling at premium prices once reserved for much newer models. Families searching for affordable SUVs or crossovers with modern safety features are left with older, less efficient options. Experts warn this could lead to long-term consequences, including higher road accidents, more pollution, and greater financial strain on households. What was once a buyer's market has turned into a desperate scramble, and every sign points to prices staying painfully high until trade tensions cool or supply chains stabilize. As America's auto industry struggles under tariffs and broken supply chains, Canada is stepping up as North America's new automotive hub. Billions in investment from Japanese and Korean automakers are flowing into Ontario and Quebec, attracted by stable policies, free trade access, and generous government incentives. New EV and battery plants are creating thousands of jobs and building a complete supply chain, from mining to assembly. Vehicles built in Canada also qualify for tariff-free U.S. market access under USMCA. giving automakers a major competitive edge. Production is forecast to double by 2028, and experts say this shift is permanent, signaling that the auto heart of North America may soon move from Michigan to Ontario. America's auto dominance is slipping away, and the world isn't waiting. As factories close and investment flees north, the next era of car manufacturing may belong to Canada, not Detroit. Subscribe for more deep global breakdowns and stay ahead of the shifts reshaping our future.